Are you tired of missing out on big profits while all of those multi-millionaire investors continue to stack some serious piles of cash? Will you see your stocks losing their value again like every time when the market collapses? One way or another, you won't be missing out again after this video. Press the like and subscribe button so that you don't miss out on anything related to stock market investing and value investing in bear markets. Welcome to 5-Star Finance, the place where you learn how to achieve financial freedom. Market crashes or downfalls can sometimes act as the worst nightmare for normal investors. Sometimes, investors get so preoccupied with macroeconomic shifts that they ignore the things that are actually under their control. That's why this video exists, so that you don't only protect your funds, but you also grow your money exponentially in the oncoming market crash. What is a stock market crash, and can you see it coming? Since most of us are unable to learn anything substantial in our school or colleges due to the system, we're largely dependent on what information we can get our hands on from different sources. So let's start from the basics. Basically, a stock market crash is something when the gains a value investor makes in some years gets turned into nothing but ashes due to a sudden recession in the market. Now, the main thing is that it can happen in years, weeks, days, or sometimes even hours. Nobody likes to see their money turned to ashes in such a short time span. When the capitalization made over the last years is burned, the value of stocks plummets to extremely low levels. The world has seen such crashes before. The Wall Street crash of 1929, the Black Monday in 1987, the Nasdaq crash of 2000, the stock market crash of 2008, and of course the recent crash which took place due to the pandemic. Now, most of the people out there are looking for shortcuts so that they can predict when the market will crash. But the truth is, this is a false errand. Warren Buffett himself says never to time the market as it is an unpredictable creature. You're only going to get yourself in trouble by doing this. So what we know is that inflation is at a 40-year high in the US economy. It's far past the mark where the Fed wants it to be at. It has never been at 7%. Truth be told, at those levels, it must be subdued. The likely result that will come out of this is that the board will increase the interest rates under Jerome Powell. To understand the complete relationship between interest rates and inflation, we need to understand that when interest rates are low, the cost of borrowing money is low. That also means that there is a big incentive for people to buy things, materials, and spend money on various things. That's why when interest rates are low, as they have been over the past few years, there is usually a lot of economic activity going on. People buy houses, cars, stocks, you name it. When they can get easy loans at low interest rates, everyone's usually up for such cash. But when people can buy so many things with that cash, the price of various things usually shoots up. This is how inflation takes place. So, as we've seen, low interest rates usually hikes inflation. Inversely, when the interest rates are as low as they are now, 7% interest rate is very high, especially for an economy like the United States. But when the interest rates are high, this slows up economic activity because now the loans are hard to come by. This means that the ratio of goods and price will stabilize and the inflation will come down. Buffett's method of profiting from a crash. Coming to the most interesting part of the video, every value investor wonders about how the greatest value investors end up profiting from a crash. Successful investors like Warren Buffett don't only make money by simply sitting in the air-conditioned offices. Continuous study and a watchful approach is pertinent for making money during a market crash. This isn't a game of chess, it is a game of preparation and knowledge. Warren Buffett is known to follow 3 rules which continuously help him to make big profits. If you can learn to apply these rules carefully with respect to your portfolio, then you can also profit from them. Rule 1. Be fearful when others are greedy, and greedy when others are fearful. According to Buffett, if you have a temperament that when others are fearful, you end up getting fearful too, and when others are greedy, you end up being greedy too, then you are not going to find yourself making a lot of money. That's the first rule. You need to be greedy when others are fearful. In fact, that's how Buffett pulls it off. As the market crashes, most of the stocks plummet to the ground. Depending on the nature of the crash, some stocks fall from 20% to even 30%, and some even more. For someone who is prepared, this means that you can buy some stocks for 20% or even 30% lesser value. While other people are busy noticing the lows, you should be busy buying stocks. Basically, this mantra of being greedy when others are fearful and being fearful when others are greedy is a very simple piece of advice. Buy when everyone sells, then buy during a low by betting everything you have on a high which is going to be the next corner. More often than not, it is the self-discipline which can take you through a crash. So that's the trick, everyone. Buy right at the middle of the crash when everything is coming at a low price. So as long as you've done proper research for the companies you're buying into, you're setting yourself up for big profits in the future. Rule 2. Spend only and exclusively what you can lose. The second piece of advice Warren Buffett gives to value investors is to spend only and exclusively what you can afford to lose. This is a general rule of investing, but it becomes even more necessary in the wake of a potential market crash. In times when some value investors see a deal of a lifetime, the urge to borrow comes up, or sometimes they buy the stocks with the money they can't lose. For example, this is usually the money of their lifetime savings. It's not usually a wise card to play, because if something absurd happens, that leaves them in jeopardy and broke. It is a terrible decision to borrow money just to buy some stocks. Just don't invest what you can't afford to lose. This advice is very useful, especially in the wake of a market crash. Sometimes the crash is too long and the borrowed money loses its value, and this can cause some serious trouble. So spend only and exclusively what you can afford to lose. Rule 3. Trade knowing that a crash will come, but not knowing when that crash will come, nor when it will end. Buffett's third advice for preparing against stock market crashes is perhaps the most important one. Trade knowing that a crash will come, but not knowing when that crash will come, nor when it will end. It's necessary to know that the market is unpredictable, and a crash is part of normal stock market dynamics, so it's not possible to know when a crash might arrive. Sometimes value investors get so preoccupied with a crash that they ignore that they can actually buy low. They get caught up in macroeconomic developments and ignore the bigger picture. Buffett simply wants you to know that a crash will come, but the time of its arrival is uncertain. If you're new to investing, check the free ebook we made specially for you in the description below. It explains the 6 different stock categories that can provide you with a decisive edge over other investors looking to gain profits and analyze stocks to prepare for a market crash. Subscribe and turn on the notifications button. Check out the video we handpicked for you, and we'll see you in the next one.